You finally got the meeting. A venture capitalist is sitting across from you. They've looked at your pitch deck, they love your idea, and then they ask one question that catches you completely off guard. Are you a C-Corp? You say no. You're an LLC. You set it up fast, it was easy, it saved you money on taxes, it made total sense at the time, and just like that, the conversation changes. Here's the truth that nobody tells first-time founders. The legal structure you choose when you start your business can either open doors to millions in funding or quietly shut them forever. According to the National Venture Capital Association, over 90% of VC-backed startups in the US are structured as C-Corporations. Not LLCs, not S-Corps, C-Corps. But why? What's so special about a C-Corp? And if you already have an LLC, is it too late? Do you have to convert? And if so, when is the right time? That's exactly what we're breaking down today, step by step. No legal jargon, no fluff. By the end of this video, you'll know exactly which structure fits your startup, what VCs actually want to see, and the smartest way to make the switch if you need to. Let's get into it. Why founders choose LLCs in the first place? Let's be honest, when most people start a business, they Google how to form a company, and within about 10 minutes, they've landed on LLC, and that makes complete sense. LLCs are fast, affordable, and flexible. You get liability protection, you avoid double taxation, you can have one member or 100. The paperwork is minimal. Services like Northwest Registered Agent, Zen Business, and Inc. Authority can get your LLC filed in your state in literally under 24 hours, sometimes for less than $50. For freelancers, consultants, small business owners, and side hustles, an LLC is often the perfect structure. But here's where founders go wrong. They assume what works for a small business automatically works for a high-growth startup. And that's where the gap begins. An LLC is built for simplicity and tax efficiency. A startup chasing venture capital is built for rapid scaling, equity distribution, and investor returns. These are two very different games, and they require two very different structures. What is a C-Corp, and why do VCs love it? A C-Corporation is a separate legal entity completely independent from its owners. It can issue multiple classes of stock, take on unlimited shareholders, and is taxed at the corporate level rather than passing income through to the founders personally. Now, you might be thinking, wait, doesn't that mean double taxation? Yes, and VCs don't care. Here's why. Venture capitalists are not investing in your business to collect a salary or take a tax deduction. They're investing to own equity and eventually exit through an acquisition or an IPO. C-Corps are the only structure that cleanly supports that entire journey. Here are the 4 big reasons VCs demand C-Corps. Number 1. Stock classes. C-Corps can issue common stock and preferred stock. VCs almost always receive preferred shares, which gives them priority during a liquidation event. LLCs don't have stock, they have membership units, and that structure simply doesn't map cleanly to how VC deals are written. Number 2. Ease of equity distribution. Want to give your early employees stock options through an equity incentive plan? That's a standard move for attracting top talent at a startup. C-Corps make this straightforward. LLCs create serious complications around this, both legally and from a tax perspective for the recipients. Number 3. Clean cap table. Investors want a cap table, a capitalization table showing exactly who owns what percentage of the company. With a C-Corp, this is clean and standardized. With an LLC, ownership is tracked through membership, interests, and operating agreements, which vary widely and can create confusion during due diligence. Number 4. Delaware advantage. This one is huge. Most sophisticated VCs will not only want a C-Corp, they'll want a Delaware C-Corp specifically. Delaware has over 200 years of established corporate law, a dedicated court of chancery that handles only business disputes, and investor-friendly legal precedents that make deal-making predictable. Services like LegalZoom, Taylor Brands, and Swift filings make incorporating in Delaware as a C-Corp extremely straightforward, even if you're operating in a completely different state. The real cost of staying an LLC too long. Here's where it gets real. Imagine you've been building your startup at an LLC for 18 months. You've got early revenue, a small team, maybe even a few angel checks in the bank. Now you're going after your C round or Series A. A VC firm does their diligence, they like what they see, and then their legal team says they are structured as an LLC. We can't write the check until they convert. Now you're scrambling, you're mid fundraise, you're under pressure, and suddenly you're dealing with a legal conversion process that costs anywhere from $2,000 to $10,000 or more depending on your attorney. The potential tax event depending on how your LLC was set up and what assets it holds. Delays in closing your round, sometimes weeks, sometimes months, and the very real risk that investor interest cools while you're sorting it out. This is not a hypothetical. This happens to founders every single day. The brutal truth is, converting at the wrong time is dramatically more expensive and complicated than simply starting as a C-Corp. If you know you're building a venture-backed startup, structure it right from day one. When should you actually convert? Okay, so what if you already have an LLC and you're thinking about raising? When is the right time to convert? Here's the framework. Convert early if you're actively planning to raise venture capital within the next 6 to 12 months. You want to start issuing stock options to team members. You're planning to hire experienced startup talent who expects equity. You're already in conversations with angel investors who are used to standardized equity structures. You may be able to wait if you're still in the idea or MVP stage with no immediate fundraising plans. You're bootstrapping and generating enough revenue to keep growing organically. Your business model isn't designed for the 10x to 100x return profile that VCs look for. Now, here's the part most videos skip. Not every startup should raise venture capital. VCs are not just giving you money, they're buying ownership and control in exchange for capital and resources. That's a trade-off. And for many great businesses, especially those in professional services, e-commerce or local markets, an LLC might be the right structure permanently. The question you should be asking is not just should I convert, but rather am I actually building a venture scale business? If the answer is yes, convert and do it before you are in the room with investors. How to actually make the switch? Alright, let's say you've made the decision. You're converting from LLC to C-Corp. What does that actually look like? There are two primary paths. Path 1, statutory conversion. This is where your LLC officially converts into a corporation within the same state. It's the simpler route, but it's not available in every state, and the tax implications vary. You'll need a business attorney to guide this properly. Services like Rocket Lawyer and Harbor Compliance offer legal support and compliance monitoring to help you navigate the conversion process cleanly. Path 2. Forming a new corporation and transferring assets. Here you create a brand new Delaware C-Corp and then transfer the LLC's assets, IP, contracts, any existing equity into the new entity. This is more complex, but it's often cleaner and gives you a fresh VC-friendly structure from the ground up. In both cases, you'll need to establish a board of directors, file your certificate of incorporation in Delaware or your state of choice, set up a 409A valuation if you plan to issue stock options, draft new shareholder agreements, and update your cap table. For founders who want a fully guided, tech-enabled approach to forming or converting to a C-Corp, platforms like Breathe streamline the entire business structuring and compliance workflow, so you're not piecing it together manually. No matter which path you take, do not do this without legal and tax guidance. The cost of getting it wrong is far higher than the cost of professional help. So let's bring it all together. LLCs are excellent structures for the right business. They're simple, tax efficient, and fast to set up. For bootstrap businesses, lifestyle businesses, and early stage ventures that aren't targeting VC funding, they work beautifully. You now know more about this topic than 80% of first-time founders walking into their first investor meeting. Use that knowledge. If this video helped you, hit that like button. It genuinely helps this channel reach more founders who need this information. Subscribe if you want content on LLC, startups, business formation, and building companies the smart way. And drop your question in the comment. LLC or C-Corp? Tell me where you are in your journey. I read every single one. See you in the next one.